Hi everyone, welcome back to Be Rich. As a treat, I've got Sashwath with me today, recording remotely, and we have some interesting things to talk about markets and how market moves can affect investments. And without wasting any more time, I'll let Sashwath dive into the topic, and then we'll have some Q&A at the end of it.
Yeah. So, breaking news, flash news, whatever you would like to call it. Very recently, we've seen that the Chinese 10-year bond yield has gone to record lows in terms of the yield. So it's gone to 1.6% as of the latest news that I'm aware of. And maybe by the time we put up this video, it might have gone even lower if the Chinese central bank has not taken any corrective action on this news. But a lot of you might be wondering, Sashwath, why is this bad news? I mean, the cost of lending is decreasing for the central bank, or rather the government in China, which means that the government is able to take more money or take money from the people or borrow from the people at a lower cost. So, isn't this a piece of good news for China? Well, there's more to it than just the borrowing cost. And the fact is that there's something known as expectations that's tied with the news that we're seeing. So, a lot of you might know after following this channel for so long now that for us, the number is only secondary to the story that the number tells us. So, the story that this number is probably telling us is that look, the interest rate has to persistently be lower over the next 10 years or whatever the long run period is, which means that the market is predicting that China will have to keep up its stimulus efforts for a long time for it to be able to pull out of a recession. So we know that over the past few years, China has been teetering on the edge of deflation and did dip its toes into deflation for quite a while. And today, its CPI is stagnant. It's at 0%. So the growth in CPI is at 0%. So that basically means they're neither in inflation zone nor in deflation zone. Or if you'd like to think of it in swimming terms, it's like keeping your head half above water, half underwater. So the person isn't drowning completely, nor is the person above the water as of yet. So this is where China is at, and we know that in around September of last year, if I'm not wrong, maybe the comments can correct me, but around September is when the Chinese central bank as well as the Politburo came out with an economic stimulus scheme where they basically talked about raising production in China, and they wanted to bring China out of the lull that it was under. And they wanted to stir investment, and they wanted to boost the stock market through a 500 billion RMB fund which they had made, which they were planning to distribute to brokers and other asset managers to be able to purchase Chinese stocks and push them up in asset prices as a way to create more excitement in the market in order for people to be able to spend. So there's something known as the wealth effect in economics, which is very simple. If, let's say, you own a rock or a stone which is 100 rupees, and tomorrow my uncle comes to you and says that, look, this stone that you have, I'll pay 500 rupees for it. Doesn't matter whether you're going to sell the stone or not. You're going to probably assume that, okay, I'm wealthy now because in a matter of a day, my net worth has almost, let's say, quadrupled or quintupled. And because my net worth has quintupled, that basically means I feel less scared, or rather less reserved about spending a little bit of income today. So if you had considered buying a chocolate for 1 rupees when your net worth was only 100 rupees, you may not reconsider it when your net worth has now gone to 500 rupees. So even though that 500 rupees is not in your hand, it's only notional. That is, my uncle is only willing to pay you in that moment. There's no guarantee he's going to pay you tomorrow. But based on his valuation of your net worth and the stone substituted with your stocks, with your gold, with your bonds, whatever it is, that means that you're going to be more willing to spend today, and that's called the wealth effect. And this is how central banks and governments try to push expenditure, or rather push demand in their economy. So given this, the Chinese central bank as well as the Politburo had ventured to be able to, along with this fund which they had created, they also said that they're going to be engaging in some open market operations, which is a neat way of saying that they're going to bring down the cost of borrowing to push the economy forward. We know that interest rates, when they're lowered, that means output goes up and the economy moves forward. And generally, lower interest rates means that economic output is increasing and GDP growth increases. So now it's about 4.5 to 5 months after what was done in September, and today we stand at a point where CPI has remained stagnant. Has been at 0%. There hasn't been any big major gain, and the fiscal stimulus which they invited as a huge impetus to the economy has possibly fallen short of its goals. Though it has only been 4.5 months, so it may not be very fair to judge it on this period. But generally, expectations act immediately, though the percolating effect takes some time to come through. So, given all this, the point is that bondholders are expecting a recessionary pressure in the Chinese market, which, and the lesson I feel like I have learned from this, and I hope all of you at home might also learn from this, is that just because suddenly Chinese stocks had rallied 20, 30, 40% even, because there was some kernel of good news, doesn't immediately mean that all is well, everything has changed, and the economic scenario has dramatically changed. And just because the bond yield has ticked downwards also doesn't mean that all is lost, hope is lost, and there's nothing more to look forward to. And what this basically means is that you should do your own particular analysis on why you have good reasons to believe whether a stock market is going to do well, whether your stock is going to do well, whether bonds are going to do well, whether gold is going to do well. I feel like you need your own fundamental reasoning to be able to invest in them rather than believing what the momentum of the market is telling you. So, what do you think about this case study, and what do you think we can learn from this?
Well, I agree with you 100% that you should take whatever news you read and market movement you see with a bag of salt, not a pinch of salt. Because this is going to apply to the Indian economy this coming year. We have been having notions of our economy being in trouble and we're slowing down. And this coming budget is going to put enormous pressure on the government to deliver something. And what it's going to deliver is what we have to watch. And no matter what efforts they've tried so far, they're not able to stimulate the bottom half of our economy to pick up. The rural area and the lower income is really struggling. Even recently, when the finance ministry had met the microfinance banks and the RBI had met them, they're literally begging the microfinance companies to go lend and lower their interest rates and lend to the people at the lower strata of society, trying to cajole them into spending and movement in the economy. And they came around and told the banks and told RBI and the finance ministry, yeah, we are ready to do that. But you also have to meet our condition that to lower interest rates to them, our borrowing costs are too high. You have to lower our borrowing costs. So that way, if you see, there's lots of moving parts in an economy. Immediately, when the rumors of this started coming, all the microfinance stocks across the board started going up. Some of them even doubled and even more towards tripled from their lows. Then suddenly today in the market, if you saw, there's huge correction in all these microfinance companies moving again towards to the lows they were at. So like Sashwath said, just because some information came, people ran and started buying it. Now some other information doesn't look like it's coming. Immediately there's some correction happening again. So like Shashwat says, you have to first understand what is happening, understand the business, the nature of it, then see which part of the cycle we are in. Everything in economy is cyclical. Like he said, it doesn't last forever. It's like seasons. It comes and goes and it changes. But no one can predict exactly when summer will start or when winter will begin or anything like that. Same way, we cannot predict when the economy will switch from, a cycle of low growth to high growth or expansion to contraction. We can't predict it. It is a natural ebb and flow of every economy and every single country. And this is normal since the beginning of time. As an investor, you should try and be aware of it. But you can't invest based on these tides of ebbs and flows in the economy. You have to invest based on value. And if you see value, then you should be investing in it and not be swayed by any of these information or news which is coming out. And what has happened in the excitement in the Chinese economy is that. Is it premature? I have no clue. Would I be putting my money inside the Chinese economy? No. That's because there's a lot of other problems in the Chinese economy, which I'm sure Shashwat will tell you what the problems are.
Yeah, I agree with you. And I think, well, as to the problems, like you mentioned with the Chinese economy, few things off the top of my head. First thing, you don't know what's going on with the Chinese companies. One, on a personal level, you just have no idea. I mean, even if you open their balance sheet, it's a black box. You don't know what's going on. Secondly, like it or not, as much as we like to criticize our own country because we are our own worst critics, as they say, but India as a country, as an example, because that's the one we're most familiar with, is far ahead than a country like China in terms of transparency. And yes, we do have our Lala companies, which basically means family owned companies. And we know that hanky panky businesses do end up going on within these companies. But for the large portion of the blue chip stocks, at least in our country, we can tell with certain guarantees. We can give certain guarantees that when you look at a balance sheet of an ITC, a HUL, or I don't know, take any other big blue chip company in our market, we can tell with a certain level of certainty that what there is what we can see. That is what we see is all there is. There isn't not something going on underneath the company. And yes, there have been deviations from this rule. There have been companies which have forged records, hidden numbers, and I do suspect a few companies in our country are still doing that. But the point that I'm trying to make is that with China, the exception is the rule. Because in India, that's an exception, whereas in China, that's the rule. And secondly, it's not because these companies are always maleficent in their actions, but also because the regulation is such that in China, a lot of the dealings have to be underhanded. So the dealings have to be under the table because the Politburo is quite distrustful of companies that get too powerful. We all know the story of Jack Ma disappearing for, let's say, I think a good 5 weeks, 6 weeks, or maybe a few months. I don't remember. But people thought that he was gone, and they found him, alive and well. But the point is that we never know what's going to happen. China asked a lot of the tech companies in China to delist from the US, and that basically tells us that fortunes can change like this. So, I mean, investing is already quite a risky game to be played, and with the risk that is already inherent in the stock market, you have this added risk of the regulator coming in and basically turning things around for you, whether good or bad. And that is a risk which we as investors need not be taking when we have a more benign environment to be investing, is what I feel. What do you think?
I agree. In that famous book, Wealth of Nations, Adam Smith, the idea of a stock market is it is for the people, the working class, to partake in the wealth of the nation.
Yes.
How does a common man, how does a family man, the lower strata, the lower class of society get to enjoy the wealth of a nation? The only way we can enjoy the wealth of a nation is just to participate in the stock market. If the stock market loses that fundamental principle, it is of no use anymore. And that is very apparent in China, where, the stock market is not the people's market anymore. It's become the Politburo's market now. From being a few billionaires who are controlling it, they wrestle it out of the billionaires' hand. And now the government of China decides what stock price should be where, like how they dictate what should be the conversion currency for the currency. Same way they're dictating now what should be the stock price and what should be done. And Sashwath, our country is far better that way. It's not perfect. Nothing is perfect. We all strive towards perfection, which is a wonderful thing. Our democracy is working towards that. We may agree and disagree on lots of things. But one thing is, we are a pluralistic society and we are always working and trying to get ourselves better, cycle after cycle of elections. And our stock market is also proof of that. There are wayward companies, but those are not the rule. Majority of the companies participating in the stock market are forthright, and the numbers can be looked at and studied and understood. And we can take a certain amount of trust in their numbers. And Sashwath is right in that. So, and the middle class in India has been participating wholeheartedly in the stock market. Proof is the number of accounts, DMATs, which have opened up since the pandemic, and the way our stock market has moved. And the median, what was considered to be the mean price to ratio of the Indian stock market has moved. From my time when I was Sashwath's age to now, where it was considered 12, 13. We're close to considering 20 now as a mean of the price to earnings in India now. That also, you may agree or not agree, but it shows the confidence the Indian public have in our stock market, because the domestic investors in India have outpaced the foreign investors by quite a large spread now. That's why even if the FIIs are pulling out 7,000 crores of the Indian market, the DIIs are able to buy another 7,000 crores and, as they say, prop up the market. Because we still find value in our companies, though if the FIIs have their reasons for selling, whatever they may be, the dollar arbitrage or whatever they have their reasons. Same reasons we Indians believe in the companies which are there. So I agree. That way we are much better off than the Chinese counterparts. But that being said, we all wondered when the Chinese announcement was made, a lot of you were asking me, Anand and Sashwath, when will the FIIs return if they're selling out so much? And even with this news which has come out, the FIIs are still selling in India. The reasons why the FIIs are selling in India is not because of the Chinese market. It is because of what is happening in the US and what is happening with Fed. Can you explain that, Shashwat, what the motivation is?
So one thing we have to understand now is that what Jerome Powell declared as the victory over inflation has hit a roadblock. I mean, maybe not a roadblock, maybe I'm putting it too harshly. But I think that there has been some sort of obstacle which Jerome Powell has come across. If a lot of you are familiar with archaeology, then you guys know that when you're going through the soft topsoil and then you go to the subsoil and then you hit a huge rock, and then you have to figure out how, you don't know how big this rock is, so you need to figure out the borders of this rock and try to excavate it or dig under it or use the weight of it against it. So Jerome Powell is basically in that position. I feel he can see the glimpses of a rock. He doesn't know whether it's a pebble that he can, flick and throw outside and continue digging, or whether it's the bedrock of that entire place which he can't go through. But regardless of what that is, he has hit an obstacle in terms of his war against inflation. And that basically means that the rate at which the Fed cuts interest rates has to slow down. And that is slowing down. That basically means the pain or the pressure which we see in the US markets is going to be at an elevated level. And we know that higher interest rates means lower liquidity. And lower liquidity means at the first sign of trouble, where money usually flows back from is global markets, emerging markets, which are considered risky in comparison to US markets. And countries like ours, India, Philippines, China, Taiwan, all these are the countries where you have emerging markets, and then the FIIs basically pull their money out of these countries and they take it back home. And as they take it back home, our stock prices decline unless you have a very solid set of domestic investors, a domestic investor base who are able to absorb this shock. So yes, it seems paradoxical that interest rates are coming down in the US, yet money is flowing outside of India. And one more thing which I want to add to that is that Trump is, I feel like maybe we've beaten the topic to death, but you can't, because it's Donald Trump. And him being the president, I'm sure a lot of you might be tired of me saying this, but him being the president means that there's going to be some changes. We don't know what changes exactly, because his temper is mercurial. He recently went back on his Ukraine deadline and he said that, let's push it further, and has surprisingly supported Ukraine with that move. But what I'm trying to say is that it's very unpredictable what he's going to do, whether he's going to levy the 60% tariffs against China. So there's another point, by the way. So 60% tariffs flat on China would mean that 1% of their GDP comes down, because 60% of their tariffs would be on 8% to 14% of their economy, which is dependent on exports, or more than that, I'm not sure. But basically a large part of their economy which is dependent on exports. And that basically means that if a 60% blow to that would mean a 1% decline. And a 1% decline in the GDP is going to be a phenomenal blow. And phenomenal not in a positive way, in a very negative way. The blow that's going to hit China if this goes through. So all things being said, I'm not saying that tariff is going to be levied. All I'm saying is that he is not of a very friendly nature towards countries like China and India as it is seen today. Though whatever history him and our Prime Minister Modi might have had, I still feel that it's unpredictable as to what Trump might do to countries like ours. So that being said, I understand why investors might be pulling their money out.
Another thing everyone should realize, the funny thing about any kind of crisis, even in history, we've seen, the last time when we had the financial crisis, money always goes back to US in any financial crisis. Even foreigners flock to the dollar, and the dollar strengthens. And a strong dollar is Donald Trump's biggest problem right now. When he comes into the office, the dollar is already very strong. All the things he's saying, the rhetoric he's saying, is going to make the dollar even stronger. What he wants is a softer dollar, so American exports can, look more attractive. And he will want some way to negotiate with the rest of the world, to everybody else to pull up their socks so the dollar looks more attractive.
I just want to add that that's folly. I mean, obviously we don't have his ear. If we did, maybe we couldn't convince him still. But that's folly, because why would you want to give up that position of having the reserve currency of the world?
No, that's what the problem is. It's a damned if you do, damned if you don't problem. He wants it softened, at the same time not too soft. He wants it to be just about right, the temperature of the dollar. So it looks attractive at the same time. It doesn't bite him back because the trade deficits they're sitting on is what he wants to chop down. And that's what all this tariff is all about. And even the Canadian tariff, he's going to want slap 25% on imports from Canada. And the Americans import literally everything from Canada. That's what Jerome Powell is saying. He's saying, I have to wait and watch what this guy actually does. He says a lot of things, but he doesn't do most of it. So Jerome Powell's like, hey, let's wait and watch. I do want to cut the rates. But now, since this is looking at what all he's saying about Greenland, the Panama, and Canada, he says, let's wait and watch. Let's see what he actually implements once he's inside the office. And then we'll take a call on it. Because if inflation starts ticking up thanks to all this tariff, and inflation is always in price expectation. Inflation is not, an actual number like you can go see that it's gone up by 1 rupee, 2 rupee, like that. If the market expects prices to go up, it will just start going up. It's an expectancy number. There is no
self-fulfilling prophecy.
Yeah. So that's why Powell's like, let's wait and watch, because it is very important to cool the inflation's tempers down. The leader of the nation has to speak that. He has to speak the language of, don't worry, we will figure this out. But we have a leader right now who's, like he says, very mercurial in his temperament, and we don't know. And we'll have to wait and watch. But this kind of volatility is a friend for value investors, because what it does is it keeps shaking the snow globe, showing you more opportunities and pockets for you to invest. So keep that in mind. It's not all negativity there. This kind of, evenness in the surface is good because it gives you opportunities to grab onto places to hold on so you can climb more and climb higher.
I agree with you completely. And I wanted to just add on to one fact to which you said, which is, let's always remember what Uncle Warren said, which is that when there's blood on the streets, I think he quotes Rothschild when he says this, that when there's blood on the streets is when you should be buying. But also Uncle Warren himself said that be greedy when others are fearful.
Yes.
And I feel like this is one place where you can be greedy without worrying about, being unethical or sort of taking more than your fair share or something. If you have skillfully identified an opportunity, then I think there's every chance for you to make use of that opportunity. And I think it makes sense. So I agree with you.
Great. So this is the outlay of the video today. I hope you guys enjoyed it. We spoke about China, we spoke about macroeconomics, and we dived into some bit of US and what is to expect going forward. And we've also spoken about what may be the play which will happen in the next few months and what to do as value investing. I hope you did enjoy this video as always. And if you like this kind of content, do share this with your friends and family. And we wish you a wonderful Pongal holiday from me and Sashwath and the rest of the team. Be safe and enjoy safe. And we'll see you again in another video soon. Thank you for watching the video today.
Thank you. Hey guys, that my uncles Vinod Srinivasan, Anand Srinivasan and I have rolled out our Substack, which is basically a blog/newsletter where we're going to post our original research onto it. And we've analyzed macroeconomic trends. And a lot of you know my uncle Anand Srinivasan and I regularly write for The Hindu. And these articles are also going to be made available for you in the Substack. The link is moatinvesting.substack.com. You'll find it in the description and in the video right now. We hope you go check it out. We've put a lot of time and effort into it. And please give us comments and feedback on what you read. Thank you.